centuries, the financial world has been controlled by large institutions. Banks, governments, and financial intermediaries have been the absolute rulers of every transaction we make. But what if we no longer needed them? What if anyone, anywhere, could access financial services without restrictions and without intermediaries? This is decentralized finance, DeFi, more than just a trend, but a revolution that is changing the global financial system. Imagine a world where you don't need a bank to save, borrow, or invest. Imagine open access to finance for anyone, anywhere, at any time, without geographical boundaries or restrictive regulations. Today, we'll dive into the world of DeFi, how it works, its advantages, its challenges, and its future. Before we delve deeper into DeFi, let's first understand how the traditional financial system works. CeFi versus DeFi. How do they work? 1. Control and intermediaries, CeFi. The traditional financial system is run by financial institutions such as banks, stock exchanges, and government institutions. They act as intermediaries that regulate, supervise, and process transactions. DeFi. Using blockchain technology and smart contracts to enable direct transactions between users without intermediaries. Case example. If you send money to a friend abroad through a bank, your money must go through a local bank, correspondent bank, and recipient bank. This takes several days and is subject to high fees. Meanwhile, with DeFi, you can send stablecoins such as USDC or DII through the blockchain in seconds or minutes with cheaper transaction fees. 2. Security and transparency. CeFi. Limited transparency. Users must trust that banks or financial institutions will manage their funds safely. However, history shows that banks can go bankrupt or misuse funds. Example, banking scandals in various countries. DeFi. Higher transparency because all transactions are recorded on the blockchain, which can be verified by anyone. However, because of its nature without intermediaries, security relies heavily on smart contracts, which can be vulnerable to exploitation. Fact. In the 2008 financial crisis, many large banks engaged in risky lending practices that led to the collapse of the global economy. DeFi aims to eliminate the reliance on this abuse-able system. 3. Transaction costs and speed. Financial transactions are often slow because they have to go through many parties. High costs due to administrative fees, currency conversions, and banking taxes. DeFi runs on blockchains that allow for real-time transactions. Transaction costs are much lower depending on the blockchain used. Ethereum can be expensive when busy, but blockchains like Solana and Polygon offer very cheap transactions. Case in point, international bank transfers can take 3 to 5 business days and cost between $10 or $50 per transaction. USDT transfers via blockchain take seconds and cost less than $1, depending on the network. 4. Loans and credit. CeFi. To get a loan from a bank, you have to go through a long process such as credit checks, collateral, legal documents, and must get approval from the bank. DeFi. With platforms like Aave, Compound, or MakerDAO, anyone can borrow funds without the need for approval from any institution by simply depositing collateral in the form of crypto assets. Big difference. Banks have the authority to reject your loan application. In DeFi, as long as you have sufficient collateral, you can immediately get a loan without having to face long bureaucracy. 5. Global accessibility. CeFi. Not everyone has access to banks or financial services. In many developing countries, people are unbanked due to strict document requirements and regulations. DeFi. Anyone in the world with internet access can use DeFi without the need for a bank account or official documents, providing financial opportunities to billions of people who previously had no access to banking services. Case in point in Argentina, banks are restricting citizens' access to US dollars to prevent further depreciation of the peso. People are turning to DeFi to store their wealth in stablecoins that are more stable than the ever-weakening peso. 6. Trust versus code. CeFi relies on trust in financial institutions. If a bank experiences financial problems or corruption, users can lose their money, e.g., bank bankruptcy. DeFi relies on code and blockchain technology. No third party manages your funds, you are solely responsible. Fact. In the 2008 financial crisis, many customers lost their savings because banks had liquidity problems. With DeFi, no one can freeze or seize your funds. Transparency is another cornerstone of DeFi. Blockchain technology enables real-time auditability of transactions, allowing users to verify the integrity of the system and the authenticity of their transactions. Unlike traditional banking, where processes are often opaque and shrouded in mystery, DeFi platforms provide users with the ability to track their funds and understand the mechanics behind their investments. This transparency builds trust within the community and encourages responsible financial behavior. From the comparison above, it can be seen that DeFi offers solutions to many of CFI's limitations. This is possible because DeFi is built on three main principles that are its foundation, namely decentralization, transparency, and accessibility. Here is a more complete description of the three main principles of DeFi. 1. Decentralization. DeFi does not rely on central authorities such as banks or traditional financial institutions. All transactions and financial activities are processed by a blockchain network spread across the world. By using smart contracts, this system allows for automated transactions without the need for permission or third-party intervention. This gives users full control over their assets and reduces the risk of abuse of authority or system failure due to a single point of control. 2. Transparency. All transactions made in DeFi are recorded on a public blockchain that can be accessed by anyone. This means there is no data manipulation or hidden corrupt practices, because every transaction can be audited in real time by anyone. With this system, finance becomes more honest and open, giving users higher trust compared to traditional financial systems that are often less transparent. 3. Accessibility. DeFi allows anyone with an internet connection to access financial services without the need for a bank account or official documents. There is no discrimination based on geographic location, economic status, or other factors. This provides an opportunity for individuals in developing countries or in areas underserved by traditional banking systems to manage their finances independently and participate in the global economy. Now that you understand the basic principles of DeFi, the next question is how to start using it. Since it does not rely on intermediaries like banks, DeFi works differently from the traditional financial system. Here are the basic steps to get started. To start using DeFi, the first thing you need to do is get a crypto wallet. A crypto wallet works like a digital bank account, but without the intermediary. Some popular wallets used in the DeFi ecosystem are MetaMask, Trust Wallet, and Coinbase Wallet. These wallets allow users to store crypto assets, send and receive funds, and interact directly with various DeFi platforms. After downloading and setting up a wallet, users will be given a seed phrase, which is a unique set of words that serves as a recovery key. This seed phrase must be stored safely, because anyone who has it can access all the assets in the wallet. Blockchain is the underlying technology that underpins the DeFi ecosystem. One of the most appealing aspects of DeFi is the potential for financial empowerment. Imagine a small business owner in a developing country who struggles to secure a loan from a traditional bank due to a lack of collateral or credit history. Through DeFi, this entrepreneur can access decentralized lending platforms that allow them to borrow funds based on their digital assets, or even through community-driven lending models. This newfound access to capital can catalyze growth, enabling them to expand their business, create jobs, and contribute to their local economy. In simple terms, blockchain is a distributed and secure database that stores transaction records in the form of blocks that are linked together. Every transaction that occurs is verified by the network, then included in an encrypted block. Once the block is full, a new block is created and automatically linked to the previous block, creating a chain of blocks that cannot be changed or manipulated. This process ensures the security and transparency of transactions within DeFi. Users can interact with the DeFi ecosystem using a crypto wallet application, and ownership of assets can be transferred by signing digital transactions that are verified by the blockchain network. Once you have a wallet, the next step is to fund it with crypto. Users can purchase digital assets such as Ethereum, ETH, USDT, or other stablecoins through a centralized crypto exchange, CEFI, such as Binance, Coinbase, or Kraken. Once the purchase is complete, the assets are sent to a previously created DeFi wallet address. This is like funding an account before you can make a transaction. Once the wallet is funded, users can connect their wallet to a DeFi platform to start using various financial services. Platforms such as Aave, Uniswap, and PancakeSwap have systems that allow users to connect their wallets with just a few clicks. Once the wallet is connected, users have full control over their assets and can start making transactions directly within the DeFi. In a world increasingly driven by technology and innovation, the realm of finance is undergoing a seismic shift. Traditional financial institutions, long regarded as the gatekeepers of capital, are being challenged by a new paradigm known as decentralized finance, or DeFi. This movement leverages blockchain technology to create financial systems that are open, transparent, and accessible to anyone with an internet connection. DeFi platforms empower users to trade, borrow, and manage their assets independently, marking a significant departure from conventional banking practices. One of the standout platforms in the DeFi landscape is DYDX, a decentralized exchange, DX, that allows users to trade cryptocurrencies without the need for a centralized authority. What sets DYDX apart is its unique non-custodial trading feature. This means that users retain control of their funds at all times, eliminating the risks associated with entrusting assets to a third party. When a user connects their crypto wallet to DYDX, they can trade directly from their wallet, ensuring that their assets remain secure and under their control. This process is straightforward. Users merely need to select their preferred wallet, such as MetaMask or Coinbase wallet, and authorize the connection, allowing for seamless trading experiences without compromising security. The significance of community governance in DYDX cannot be overstated. Unlike traditional exchanges that operate under the control of a centralized entity, DYDX is governed by its community of users through a decentralized autonomous organization, DAO. This structure empowers users to propose and vote on changes to the platform, ensuring that decisions reflect the collective interest of the community rather than a select few. This democratic approach not only enhances user engagement, but also fosters a sense of ownership and accountability among participants, which is a cornerstone of the DeFi ethos. As users engage with DYDX, they may find themselves intrigued by the lending and borrowing protocols offered by platforms like Aave and Compound. These protocols revolutionize the way users can access capital. Aave, for example, allows users to lend their assets to a liquidity pool and earn interest over time. The process is automated through smart contracts, which are self-executing contracts with the terms of the agreement directly written into code. When a user deposits their assets into Aave, the smart contract manages the distribution of funds and ensures that borrowers pay back their loans with interest, all without the need for intermediaries. Compound operates on a similar principle, allowing users to supply their crypto assets to the protocol in exchange for interest. However, what makes Compound particularly innovative is its use of C tokens, which represent the user's stake in the liquidity pool. When users supply assets, they receive C tokens in return, which accrue interest over time. This system not only incentivizes users to lend their assets, but also provides them with a way to track their earnings and liquidity within the platform. One of the most groundbreaking features of these lending protocols is the concept of flash loans. Flash loans allow users to borrow assets without collateral, provided that the loan is repaid within the same transaction block. This mechanism opens up a world of possibilities for traders and developers, enabling them to take advantage of arbitrage opportunities or execute complex financial strategies without needing upfront capital. For instance, a trader might borrow a large sum of money through a flash loan, use it to exploit price discrepancies across different exchanges, and repay the loan, all within a matter of seconds. This innovation not only showcases the power of smart contracts, but also highlights the efficiency and speed that DeFi can offer. In the DeFi ecosystem, stablecoins play a crucial role in providing stability and usability. One of the most prominent stablecoins is DAI, which is collateralized by a variety of assets locked in smart contracts on the Maker protocol. Unlike traditional fiat currencies, DAI maintains its value through an automated system that adjusts the collateralization ratio based on market conditions. Users can generate DAI by locking up collateral in the form of cryptocurrencies, such as Ether. This process allows them to access liquidity without selling their assets, giving them the flexibility to manage their portfolios effectively. The utility of stablecoins like DAI extends beyond mere transactions. They serve as a medium of exchange within various DeFi platforms, allowing users to earn returns in liquidity pools or participate in yield farming. By providing liquidity to decentralized exchanges or lending protocols, users can earn interest or rewards, further enhancing their investment strategies. The ability to leverage stablecoins in this way underscores the innovative financial opportunities that DeFi presents, enabling users to optimize their returns while minimizing exposure to volatility. As the DeFi landscape continues to evolve, the practical applications of these principles and technologies are becoming increasingly evident. Users are no longer passive consumers of financial services. They are active participants in a decentralized ecosystem that prioritizes autonomy, transparency, and community engagement. Platforms like DYDX, Aave, and Compound are at the forefront of this revolution, providing users with the tools they need to trade, borrow, and lend independently of traditional institutions. The implications of this shift are profound. As more individuals recognize the benefits of DeFi, traditional financial institutions may find themselves at a crossroads, forced to adapt to a world where decentralized solutions offer greater efficiency and accessibility. In a world where traditional financial systems often falter, decentralized finance, DeFi platforms like DYDX have emerged as a beacon of hope, particularly in countries grappling with economic turmoil. Argentina, a nation steeped in the struggles of hyperinflation, stands as a vivid testament to how DeFi can empower individuals and reshape the financial landscape. With inflation rates soaring to an astounding 211.4% in 2023, peaking at nearly 300% in April, the Argentine peso has faced a relentless devaluation, eroding purchasing power and plunging nearly half the population into poverty by early 2024. In this dire climate, many Argentinians have turned to stablecoins such as USDT and DAI, which are pegged to the US dollar, as a refuge for their dwindling wealth. Between June 2023 and June 2024, a staggering $91.1 billion in cryptocurrency transactions flowed through Argentina, with 61.8% of those transactions involving stablecoins. DeFi platforms have facilitated this transition, allowing users to convert pesos into stablecoins and store them securely in crypto wallets, bypassing the limitations imposed by local banks on foreign currency transactions. This newfound financial autonomy not only protects their assets, but also opens doors to opportunities previously unavailable in traditional banking systems. Moreover, platforms like Aave and Compound have introduced earning potential through staking and lending, offering competitive interest rates that far surpass those found in conventional banks. As President Javier Milei took office in December 2023, his reforms aimed at stabilizing the economy included a supportive stance on cryptocurrency. While these changes have posed challenges, they have also sparked signs of recovery, such as a reduction in monthly inflation and a gradual restoration of confidence in the peso. Yet, the road ahead remains fraught with obstacles, particularly for retirees whose pensions have diminished in value amidst ongoing high inflation rates. Decentralized finance, DeFi, has emerged as a revolutionary force in the financial landscape, offering a new paradigm that eliminates intermediaries and democratizes access to financial services. However, its rapid evolution has not been without significant challenges, particularly concerning security and volatility. The decentralized nature of DeFi, while empowering, has also exposed it to vulnerabilities, especially through weaknesses in smart contracts and network infrastructure. High-profile incidents have underscored these risks, with a Poly network hack in 2021, resulting in over $600 million stolen, and the Ronin network breach in 2022, costing around $620 million. These breaches illustrate the precarious nature of DeFi, where billions in assets can be lost in an instant due to a single exploit. The volatility of cryptocurrencies like Bitcoin and Ethereum further complicates the DeFi landscape. Prices can fluctuate wildly, driven by market speculation and external economic factors, which can lead to significant financial losses for users and investors alike. This inherent instability has raised concerns about the sustainability of DeFi protocols. In response to these challenges, the concept of DeFi 2.0 has emerged, aiming to enhance security and sustainability within the ecosystem. Innovations, such as protocol-owned liquidity, POL, allow protocols to maintain control over their liquidity, reducing reliance on external market conditions. On-chain insurance for smart contracts provides a safety net against potential exploits, while self-repaying loans create a more efficient borrowing mechanism that minimizes risk for lenders. Looking ahead, the future of DeFi appears promising, with projections indicating continued growth and integration of blockchain solutions. According to Zion Market Research, the DeFi industry is predicted to grow at a CAGR of 42.6% and reach USD 232.20 billion by 2030. Compound annual growth rate, CAGR, is a method used to calculate the average growth rate of an investment or industry over a certain period. As the industry adapts to regulatory changes and strives to build a more secure and inclusive financial system, the lessons learned from past vulnerabilities will drive innovation. The evolution of DeFi is a testament to resilience and adaptability, paving the way for a more robust financial ecosystem that can withstand the pressures of an ever-changing market.